Alright, hello guys, and glad to have you on board again today. This is one that I thought I already cleared out, but turns out it wasn't the case. So I'm really gonna have to record a video about that to get into the greater details and the nitty-gritty of that pattern. That is, to put it into context, the replicate but opposite version of the one that has been pretty well documented all across the web, which is basically this bubble to crash pattern, which creates extensive positive feedback loop on the prices to the point that they will severely deviate from the mean valuation of the underlying asset, until the point these positive feedback loops tend to somehow reverse all on themselves, creating negative feedback loops which would destroy the prices, until it of course goes right back to the mean area, which will have some of extended negative consequences beyond and below the mean value, before of course going right back to that mean valuation after the time. So these are patterns that are generally fed in context in which supply is a constraint. So first thing to note in here, okay, when you see these bubble patterns, generally means the supply is very tight. A tight supply, which has a very limited way of evolving, is generally what favors the creation of those automatically bullish feedback news. So in these things, this is basically the typical way of creating those bubble to crash patterns, is to have an asset which has a clear long-term trend, and in that perspective we're quickly going to take off and go parabolic in a limited supply, because the demand will go from speculative to hyper speculative, fed by media attention, and then people make tremendous profits, so they get to touch their near people's proximity and stuff like that, and it creates even more greed, and then it turns out to be like this is a revolution, and we are absolutely out of any rational standards of valuations, but people don't give a fuck. Though, of course, these positive feedback loops terminate generally in two ways, either because there is an increase in supply, meaning that those who are holding the supply over the long term, or those who have significant implication on the supply distribution, can at some point just terminate the bullshit. They will sell massive shares of their supply, and in that perspective, there's not going to be enough retail money to buy it out. So in that perspective, we'll just terminate the pattern by breaking the bullish trend. And then, of course, turns out that the message is sent to the rest of the markets, at least for those who know enough: sell, sell, sell the fuck out of here. And of course, there will not enough be buying pressure against that, and the thing will all collapse back to the mean. Though this thing is just basically like, if we were to sum it up, the essential is to understand that there is a psychological distortion that creates an over-amplification of bullish and positive emotions, which will afterwards create the same negative effect on the opposite side. And though we'll see that emotions turn to absolutely horrendous bearish type of things. So this is really not more than that. The prices will deviate severely from the mean, but end to end it just goes that this distortions just goes right back to the mean anyway. So it is just no more than a speculative end motivation of the demand side on the equation. But note that very clearly, it generally needs the supply to be under constraint, okay? Though what we're going to be talking about today is not this. This was just a TLDR about that pattern. What we're going to talk about today is the replicately opposite version of it, which is when the market deviates severely from the mean, but to the downside, okay? And how will this pattern create the same positive than negative feedback loop, but reversed, meaning that we'll get a set of negatively amplified sentiment, which will turn out to create positively over-amplified sentiment afterwards, both ending in the same way, meaning that we will just go back to the mean, period. It's just that the amplitude is reversed. But there's also one very important, crucial thing that we need to talk about first, is that price is a portion of our equation, and price can't be equal to the upside and to the downside, due to the simple fact that there is a row limitation to prices to the downside. It's zero. If asset prices can't go negative, in some rare cases though, but despite that, asset prices are bounded by the zero value when they are unbounded by unlimited potential upside due to just imagination of people, as long as someone is willing to trade and no one is willing to take the opposite side of that bet with a higher volume, then in that perspective, basically prices can rise endlessly. Of course, there is a limit to this. Things can just go parabolic forever. But the thing is that you can hardly set a limit to that but the human's imagination. To the downside, though, it's not going to be the case. We know that anyhow and anyway, if the asset has an underlying mean value, we're never going to go to zero, okay? So, of course, we can go tremendous drawdown out of the mean, but still, we're never going to go negative, okay? So understand that there is a roof. There is no roof limitation when the pattern plays out to the opposite side, which will generally create an asymmetric return. In terms of deviation to the mean, we deviate more to the upside than we will to the downside. We have to understand as well that this mechanic will be reversed on our opposite pattern. Okay? So now we've got all the TLDR. So let's talk about the pattern itself. Though the thing is that this is the same thing. Though the context is generally pretty similar, these patterns have a high probability to occur when there is a constraint on supply. So if your asset is trading around 15% supply in exchanges and so on, this is an early sign that we are at a critical supply level, and this is where the psychological distortions can move prices more significantly one way or the other, and this may create those distortions which will have anyhow and anyway the same thing, meaning that this is kind of an oscillation of degraded sentiments and then upward reversing, okay? Though this will be amplification of negative sentiments and then amplification of positive sentiment. Of course, this is that if you know this pattern well enough, and if you can pull it into the right context and knowing all of the intermediate maturities, you have an hedge on the market. This is basically that most market participants will be under influence of those extreme emotions, and the end is just that we'll go back to the mean period, but you will be efficiently navigating this pattern instead of just falling for the cracks, okay? So this is really what this is all about. Don't try to use these patterns all across the board. They are by definition rare. They require tight supply management, long time frames, because these things don't happen in the short run. The thing is that we need to figure out an opposite version of what we've seen for the bubble. The bubble is an automatically bullish feedback loop because people get interested by the fact that prices rise, so they get more media attention, and the neighbor starts to talk about this thing, and then it drives more people in with the same old tight and limited supply. So this creates even more constraint on the supply side of the equation. But the thing is that this automatic feedback loop, we need to find the recursive opposite of it, in which, of course, the negative sentiment in the market will be influenced, and then there will be over-bearish perceptions in this market. So what could it be? Of course, the same old thing, the mean value must be identifiable, and normally it's going up because we don't pay attention to assets which mean value goes down. But the mean value going up is the second prerequisite for this pattern. Tight supply significantly increases the probability of seeing the pattern. Identifying clear mean value going to the upside is the second thing. And the third is that we need to find a negative feedback loop, which pushes prices down. Though I know two of them that have very recurring way of happening. The first one is that when we're in an economy which has, if we put an XY axis type of thing, okay, and if we put the growth on the X axis, basically if we put the money supply into the opposite axis, or more importantly, the price mechanics, meaning that here we are in inflation territory and deflation, meaning prices going down and prices going up, and here is positive growth and negative growth. So in that perspective, when we enter this area, meaning negative growth and deflation, we generally have what we call a depressive environment, an economical depression, which is a negatively automatically feedback loop. The further down we go into this extreme territory by deteriorating growth in significant ways and having significant deflation in the economy is an automatically feedback loop, because deflation means people expect prices to go lower, so they don't buy because they think they'll be able to buy that same thing at a cheaper price in the future at a discount. So they stop buying. The fact that they stop buying means that the growth is deteriorating even further, which is creating deflation and so on. So this is necessarily a negative feedback loop. Negative price expectation means people buy less, which creates more deflation and prices go down and so on. But like we've seen, there is a roof to there's no roof to the market to the upside. It's just until the last buyer buys. But in the opposite direction, there is a roof. There's a floor limitation. We just can't go down to zero. A TV can't cost zero. It always has to cost a price. So the thing is that these patterns terminate when we deviate too much from value until the point that it makes no sense anymore. So these patterns have an end, just like speculation cannot automatically feed itself indefinitely. Okay, the second economic environment in which these patterns tend to occur is recurring feedback loops of liquidation. Cascading liquidation, to be precise. This is exactly what we've experienced in the crypto market this early summer as well. So this is the reason why I've mentioned these patterns, because I think they have high likelihood to play throughout the market. Tight supply and cascading liquidation. Because the cascading liquidation basically has the same automatic feedback loop. You have a first event that liquidates on a significant amount, but still, then the market tries to digest. But the thing is that liquidation have a collateral damage kind of effect, which means the first liquidation might create a second one, which will be bigger in general, which creates second collateral damage effect and creates the third liquidation, which will go even bigger. And you can see that immediately the same old parabolic scheming shit turns to play. And yet people have the same old recurring stupid overextension of their emotions. They think the next is going to be even bigger, that the next one is going to blow everything out, the entire economy is going to be wrecked, everyone's going to get liquidated because, well, we just go bigger and bigger. Limited things. Remember that what we said, at some point we deviate so much from the mean that these patterns just can't play out anymore. So this is the thing. These are the two contexts in which this pattern tend to occur recurringly. Okay? Tight supply is condition number one. Median value must be visible. We don't apply that pattern on an asset that doesn't have long history and stuff like that. Moreover, remember that we don't pay too much attention if the median value is going to the downside, okay? So the median value has to be an interesting asset to invest on. We just navigate the price volatility more efficiently because we have an edge on the fact that the market will have amplified positive and then negative emotions. And in that side, this will be amplified negative emotion. So you're going to have an edge to fight against those negative narratives. And then you know that they will turn out to be over positive as well, and you will have the tools to fight against it as well. So you will kind of maintain a neutral stance, not falling for the price structures that will induce psychological mismanagements. So anyway, here it is. Now let's talk about how we trade that pattern, just like the way we could trade crashes, which is something that I can eventually teach you at the very end of my coaching, because it requires a shitload of information to be processed correctly and in the right order to be efficiently traded with a nice risk limitation. This is not an easy pattern to trade as well. But this one I think is far easier in terms of risk limitation due to the asymmetry that we've mentioned before. It's far easier for me to tell you that these patterns, when you can clearly identify a rising median value, and when we deviate severely below that value due to either depressive economic environment or cascading liquidation, then in that perspective you will have this pattern playing out, or at least very likelihood to see that pattern play out when the market will create its return to the mean, okay? So in that perspective, this one is easy because we know that there is a floor limitation. We know that anyhow and anyway assets can go negative. So it's far easier. Why is that? Because short selling a bubble requires short fucking selling, meaning increasing the supply of an asset by borrowing it to sell it on the market with the promise that you're going to have to buy it back. And like we stated, the people's dumbness can go to the infinite. So if you sell something with the promise that you're going to have to buy it back, and if it goes out of control, then liquidations can be very costly in a bubble. So it's far more dangerous and require far more understanding of risk management and psychology to short sell a bubble. It will be far easier actually to buy these opposite patterns, because basically as long as you don't use too much leverage, and if you buy just the spot market, well, normally it's going to be easy. The outcome is that you can predict the loss associated with it. So if you put it into a speculative manner, if you have 2 to 5% capital at best exposed to these patterns, well, you have a definitely good risk limitation. The end game is, if it doesn't play out, the worst case scenario is that you lose it all. But if normally you've identified an asset with a rising median value, these things can't happen. So you'll always recover something. You just won't lose it all, okay? That really is what this is all about. When on the opposite direction, you really can lose it all if you don't manage tightly. Okay, so that's one thing. It's going to be easier to manage. But that also means that the returns won't be as big as on a crash, okay? The median deviation is, of course, normally lower than what it could be to the upside due to those same old asymmetric behaviors. Okay, anyway, so how to trade? Each pattern, just like short selling a market that is in a bubble, has intermediate stage maturities that needs to be respected correctly in order to play the pattern further and further as the stages mature. This pattern has 7 stages in the way I trade it. Stage number 1 is just basically falling fucking knife. Basically, the market is falling in a straight line due to either those negative feedback loops, whether being cascading liquidation or depression environment. In that perspective, the narrative definitely is, don't catch the falling knife, let the market bottom, just don't do anything. Of course, number 1 mistake is people use leverage because they feel it as being the lifetime opportunity. Prices below value, so boy, I'm buying and buying and buying and buying and buying, and you end up leveraging your calls without even knowing about it, because every new dip feels like an even better opportunity to get at a cheaper price. But the problem is, quickly you end up leveraging your positions without even knowing it. Stage number 2 generally comes with the market reaching out the floor value, meaning we deviate severely from the mean, and at this point people keep on automatically feeding themselves with this negative environment. The sentiment goes extreme. People are like absolutely persuaded that the future is inevitable. It's going to be there. It's going to be painful. It's going to be horrible because it has to be that way. It can only just go worse. That's exactly what we know now, by the way. But the thing is that prices have reached floor. So the thing is that what was automatically feeding the loop back then is starting to deteriorate significantly. Like the probability of having an even bigger liquidation now is seriously decreasing over time. Just like in a depressive environment, when prices have significantly drawn down for several months, quarters in a row, at some point will reach out a floor price, which means, well, there's no more transaction anymore. No one is even selling. People might still wait to buy cheaper, but at some point the prices tends to stabilize. And this is where we reach out equilibrium again. What we see is generally a volatility reduction and flat patterns building the bottom. But the thing is that everyone will see that as a continuation pattern. The thing is that it's really recurring. Every time in these patterns play out, everyone will see that as an inevitable temporizing pattern before going lower, because the next thing will hit us harder than the previous ones as well. Though the thing is that anyway, 2 things happen in here. Either you get liquidated by lower shadow candles because you were buying with leverage with a stop loss, or worse, you're going to start convincing yourself that the narrative was right, you were wrong, it's an appropriate time now to try selling to at least make a few bucks in this market. Really the biggest mistake ever. Stage 3 is that normally it doesn't make too much noise, but the pattern of those flat consolidations are generally broken up. These are short-term flat consolidation. Okay, generally on the long run it looks like a V shape, but in here you see a kind of a weird hesitation, and then the market breaks up out of this hesitation. Though stage 3 is really this, the structure is broken up and the narrative is generally this is a technical fake out for just a deeper retracement, which will give us an even better opportunity to sell again. Number 1 mistake is that people refuse to take their stop losses out of this because just basically, well, no problem. I'm going to build my bearish position slowly but steadily. Like I said, we deviate from the value. We're below it. So this is the crucial mistake number 1. We're so far off the value. Trying to follow the narrative is not going to be an easy task to do, and it's going to be stupid. Stage 4 is the crucial turning point for this pattern, meaning that this pattern is speculative on the first 3 stages, because at stage 4, this is where we'll see the difference between either the pattern playing out or just the market being in a natural bearish trend. Because in bear trend context, moving averages will go down, prices will go down, and this is the point in which we're going to get to the pullback to final excess, meaning that we turn back to the mean, we create kind of a range, and then comes the final excess, which will push us to new low, and this will be the end of the trend. This is where the low risk calls can be made. So this is a bear trend, but the thing is that what we have in here is no such a thing, and that's the number 1 mistake. Deviation to the mean by automatically negative feedback loops is just as not a trend that a bubble is. A bubble is nothing close to a trend, and it doesn't follow the same structures. There's no pullback to final excess in a bubble. Same thing goes in here. There will be no pullback to final excess because this is not a trend. it's deviating from it. But of course, most of the time, markets just trend. So remember that there are some significantly important contexts for these patterns to play out. You don't play that in a 15-minute chart. It doesn't make sense, okay? You need to see recurring psychological feedback loops that generally tend to play out on longer timescales. The second thing is that you need to have a clearly visible median value out of this. Otherwise, it's probably just an asset that doesn't worth it. So really pay attention to this. Don't take these patterns everywhere. The thing is that stage 4 is where we'll start to see normal traders seeing the deviation from the pattern, because normally in here they would sell and buy lower, but this time it's not going to work. This pattern generally plays out with ranging patterns across the moving average, sometimes above, sometimes below, sometimes just across the moving average, but it's generally stage 4 is trading at the moving average price. The narrative, the most common narrative is, yes, it's time to sell for new lows because most traders are trend traders, so they will sell with a stop loss. The thing is that the number one mistakes that prepare for the rest of the pattern is that other traders refuse to take their stop losses so far. They've already eventually entered short right at the bottom, and they will start piling up new positions in here and reinforcing new shorts. So this is where there's starting to be leveraged short selling in a market which is trading below median value. That's not going to be an easy task to do, because this generally triggers stage 5, meaning that we're going to start coming from the stop losses of these guys and the ones of those who legitimately have been trying to trade a pullback to final excess. Once again, trend trader will definitely see their usual trend patterns, and they will, most of them, convince themselves that it is worth buying cheaper. And then in that perspective, this is a normal speculative call in which you sell the market, not a call, basically. You put the market in here to just buy it at a cheaper price, okay? Though, of course, all of these bets will be newelled by the market, which will take out their stop losses. The good traders will do what they have to do. They'll take their stop losses. The noobs who are under heavy psychological influence and mismanagements will keep on reinforcing their sold position and holding a big loss, hoping for the market to drop. At that point, the narrative will clearly switch. The professionals will see that the bottom is in. They took a stop loss and they will acknowledge the difference. The knowledge is, well, we're no longer in a bear market. We might have gone wrong. We took a stop loss and we're going to readjust. The thing is that still, risk managers will go for this. Wait for a decline to form a major high or low point, because that's what risk managers do. They don't buy above a moving average and stuff like that. They're going to wait for the market to dip in order to go up. But the thing is that it won't happen because of this, because of the other traders who are locked in a definitely destructive embrace. The thing is that they will keep on reinforcing bearish position until they end up being liquidated, and or until at some point the rest of the market enters long on a FOMO trade, meaning that once the bears got liquidated, they will somehow figure out, okay, the narrative was right, the bottom is in, we're never going to get that lower high point, so let's just drop that shit. I'd rather like to be bullish now. And the same old guys who will end up being liquidated at stage 6 will be the same ones who generally enter FOMO afterwards. And this will create the market to do just one thing, stage 7, meaning the market does absolutely nothing. The prices flatten and retrace to the average, as those who bought the lows are profit-taking to those who are now FOMOing in. And this creates kind of a weird balance in which generally the moving averages go flat again when the prices do the same thing. In that perspective, this was obviously an excessive dip becomes the main narrative. Everyone agrees to the fact that this is where it has to be bought, and those who are waiting for new lows just have been wrong. Of course, some of them have just taken a speculative loss in here because they were taking their trend trades, and they got it wrong. But most people will do this. They will end up being bear, refuse to stop loss, reinforce short position, hold a big loss, get liquidated, and this will fuel this pattern to the upside. So remember what it is, okay? It's really going to be it. The automatically bullish market fueling will create an over bullish sentiment. The thing is that people will feel like the market is too bullish, and that will have to fall sharply because of it. Don't go around this. The sentiment is going to be irrationally bullish on prices, but most of the market participants will fight against it. Just like they're buying the bubble when it crashes. They will short sell the rebounds because it will feel like it is not normal. It shouldn't be there, it shouldn't have been that. These guys were the same ones who were probably willing to buy in the first place. So pay attention to this pattern. It can be very psychologically problematic, okay? So this is really what this is all about. And of course, as the pattern retraces in here, there's a general common thing that generally retraces to half the drop, meaning that we go in here and this price area is generally recurrently out of 50% retracement of the big drop. Okay, so I'll just show you what it looks like in terms of price patterns. So we have a clear example in here going on right now immediately on the market with Ethereum. And you can see the pattern has been in play. So I've put it the volatility boundaries because the intermediate trend maturity, generally stage 5, are generally played at volatility boundary. So what you would like to see in those patterns, like I said, is a clear history median value rising. You would take a regression trend, pull it out there. As you can see, the median value is just going up and we're severely deteriorated below while the moving averages are still rising and stuff like that. So this is a clear evidence that we're trading below the median value at a significant discount. You need to see the context. Like we said, limited supply. We definitely have seen all of these asset supply being shrinked as the prices were going down, which is quite not normal. The second thing is that we've seen cascading liquidation events. So we've got all the prerequisites for this pattern to play out. The moving average goes absolutely vertical, and we can see in here the quick accumulation that has been broken to the upside, and prices have retraced the mean. So right now, if this pattern is at play, and it definitely feels like it is, we've got all the prerequisites for this, we would be in stage 4 now. The market is building the range, and in terms of Ethereum, we're building that range below the average. Breaking that moving average and reaching out as close as possible to the volatility boundary will be triggering stage 5. And stage 5, remember what it is where the pattern is confirmed. So this is the point in which the psychological mismanagements will automatically fuel the pattern to complete itself until stage 5, 6, and 7 pull us right back to some kind of 50% range, which will definitely look like intermediate flat to impulsive markets. The technicals that you want to follow is that stage 5 goes from breaking out the stage 4 range and price continuing above the moving average. The stage 6 is generally consisting of a second short-term range, which generally happens when the moving average is turning positive again. Okay? Though these are the intermediate stage maturity. When we break out a range that has constituted itself around the moving average, stage 6 comes after building a second range. Generally, range of stage 5 is built at the volatility boundaries, which are generally closed at that point. Okay, so the volatility boundaries are doing something like that. Okay, and here the market will be, people will be hoping for a major high-low point. They will be hoping for prices to go for the lower volatility boundary. It won't. It will keep on rising, fueled by the patterns that we're talking about. Okay, those stage 6 is basically fueled by liquidation of the shorts, and then at a later stage, the FOMO trades, which will inevitably switch that automatically fueled stuff to a row 50% retracement in which things will balance out and everyone will agree that this was an excessive dip. Okay, so really what this is all about. Though you can clearly see this on Ethereum as well on Atom. We can take this, median values rising significantly, we're far below it. There has been cascading liquidations in here as well, Terra Luna. We have retraced to a falling literally significantly on a straight line moving average. We're building a range across the moving average on this one. Next stage is to go to the volatility boundary, building a short-term range, and keep on pushing until we get close to 50% retracement or so. Okay? So this is what it is. Currently, Ethereum and Atoms do play this pattern. We had the staked ETH liquidation for Ethereum. We had the Luna collapse on Atoms ecosystem. They are definitely favorable candidates for this pattern to play out. Now I wanted to show you kind of a more historical pattern in which these environments played out, because I like pattern when they're not centered around a single asset class or whatever. So this pattern plays out everywhere, like we stated. It plays as well in the stock market. If we have a look at the S&P 500, for example, in the 2008 era, just look at that. Same old pattern. Median value is rising. As you can see, the long-term moving averages were still rising, significantly deteriorated at that point, straight line. Back then, this wasn't cascading liquidation. It was more of a depressive environment. Prices were going down on so many sectors, and people were expecting prices to go down endlessly. Okay, we can see that there's this pattern building, the volatility gets shrinked, and then boom, the V bottom immediately retraces to the average. When we're trading on the average, a short-term range is building itself in here as kind of a weird short-term pattern oscillating across the moving average until, bang, we go back to the moving average, and the moving average recovers positive as prices keep rising. In the end, volatility boundaries goes flat again, just as the moving average does, and this correlates to 50% retracement. Okay, so this really is what it is. And of course, as this pattern terminates, everyone will agree that a massive bottom's been made, and then the pattern can either recreate a trend or re-push us to the downside. But this is where we reach out the standpoint in which everyone agrees that something had happened. And if you want to navigate it well, you need to know the tricks. So don't create these patterns everywhere. If you see a falling moving average, that doesn't mean the patterns are here. Remember, it happens on larger time frames. These things can happen in a 1 hour chart time frame, okay? This requires a tight supply, and this requires an external context to create negative feedback loops. The favorable ones are the ones I've mentioned in this video. That being said, you now know everything about that patterns. Where are the technically visible areas in which these patterns are at play, what fuels them, what pushes them right back to the mean. So I hope you make a good use of them. Bye-bye.